Hello, everybody. Welcome to another great webinar panel from Reuters Events Insurance. I wanted to welcome you all. I'm your host, Brian Falchuk. I'll be moderating today's session. I'm the managing partner of Insurance Evolution Partners and the author of the book series, The Future of Insurance from Disruption to Evolution, which is a very polite and sly way of sneaking in. Second book just came out. Go pick it up. So I will stop self-promoting after that. Thank you all for joining us. This is, it's an interesting period. We're coming out, a lot of us, from 16, 18, whatever months of lockdown, this rapid period of change where we suddenly had to make major shifts, accelerate digital transitions, look to make ones we weren't even thinking about before. And we did it. We did a lot in a very short period. And so now the question is, where do we go from here? And, I hear some folks talking about, let's take a breather. Others recognizing the pace of change is markedly different. The demands from our customers, from our broker partners, from really the entire ecosystem and the markets we serve are different. And that will not go back in the bottle. So how do we continue the change that has really brought itself front and center, but in a sustained way, in a strategic way, in a more cohesive way than just being, the sort of reactionary, although valuable way that we did it in the past several months. So with that context in particular, thinking about the underwriting world, that is why we are here today for this panel. And I want to introduce our speakers, and then we'll go through a bit of opening remarks from each of them in succession, and then move into Q&A. There's a little Q&A button at the bottom of your screen in Zoom. Click on that, ask your questions at any point. You don't have to wait till the Q&A begins. You can pop your questions on there, and I will watch them and offer them up to our great panel to discuss. So please do share, because that's what guides our conversation. We want to make sure we're talking about the issues, the things that you care about most. So do ask your questions in the Q&A. All right, with that, let me introduce our panel, and then we'll move into some opening remarks from everyone. Starting off is Abel Travis, who is the Vice President and Head of Fundamental Underwriters at AF Group. So Abel, thank you for joining us today. We're going to open with you, but I'll get to you in just a moment. Let me introduce the rest of the panel. We also have Janet Moylan, who's a Senior Vice President for North American Underwriting Operations for Allied World. And we have Eugene Lee, who is the SVP and General Manager of the Insurance Suite for Guidewire, and Stephanie Rushforth, who's Senior Vice President and Head of Underwriting Operations for Hiscox USA. It's a great panel with some really rich perspectives from an underwriting side and people who have been living this stuff firsthand, all the change that's been going on and the change that's coming ahead. So I'm excited to dig into this. Abel, if we could start with you, if you wouldn't mind. Love to hear some thoughts for you to kick things off.
Yeah, thanks, Brian. I appreciate it, and I'm absolutely glad to be here. So, first, just really quickly before I kick things off, I just wanted to give folks an understanding of who I am and who I work for. So, as Brian mentioned, I'm Abel Travis. I work for a company called AF Group, a 115-year-old organization in the Midwest, and I am the head of Fundamental Underwriters, which is the growth and diversification arm of AF Group. When I think about the last year, Brian, it's been pretty exciting just to see sort of that transformation that we've experienced because of what the pandemic somewhat thrust upon us, right? But not only that, with that, we've started to see what I would say would be sort of the rapid implications of some of these new risks that we've been seeing not only as an insurance industry, but just in general. So, what were some of those new risks? There are things like rapid digitalization, for example, in which people were forced to work and do their education and shop and essentially do everything in a digital manner, which essentially wound up forcing organizations to adopt those digital capabilities just in order to survive. We've seen a lot of socioeconomic challenges at play, as well as, changing business and service models. And then essentially what we've seen from cyber risk, ransomware, and then what some of the challenges that we face from a cybersecurity perspective. So I'll get into a little bit of that as I'm talking, but really, let's really start and dive into that rapid digitalization. So I mentioned that even prior to the past 12 months, we've been seeing rapid digitalization in the insurance industry, with our industry being impacted by organizations and industries that have nothing to do with what we do on a day-to-day basis. Those insurance companies, from my perspective, that really have their digital infrastructure in place and drove that digital enablement, I think, were those that actually had the opportunity to quickly accelerate their ability to onboard this rapid digitalization, as we've seen was sort of thrust upon us, as I mentioned, over the past 12 months or so. But then, that really then helped to, I think, accelerate other aspects of the underwriting process. So, especially when we think about that thought from going, from a reactive underwriting to proactive. So, leveraging that data that's out there in the ecosphere, that more localized, granular data through partnering with other organizations like third-party organizations, Convert, DataCubes, and organizations like that, to really take that information into the underwriting process to then help the underwriters really understand through using data that's not necessarily being collected from the agent or from the from the agent or from the insurer, but really going out to grab that information and then applying it to the underwriting process. There are millions of terabytes of information that's also being proactively collected through things like IoT devices, auto telematics devices, especially in, large commercial auto, trucking and so on, as well as wearable devices when you think about individuals that's working in manufacturing facilities and those facilities that are trying to keep their employees and their workers safe. So, in essence, when we think about pulling all of that together and really enabling it as a part of that larger ecosystem, really, I think that solid digital infrastructure is what helps to enable, that component of rapid digitalization that we've seen over the past 12 months. And then the last thing that I would add to this is, especially as we started to see insurers enable other organizations and other third-party providers and vendors plug into their infrastructure and their ecosystems, we've seen a lot of risk from a cyber risk perspective. I think in the fourth quarter of 2020, as well as the first and second quarter of 2021, we've seen the most impact that we've historically seen due to ransomware. So, for those that aren't aware, there's what was the larger insurance carrier, and I'm not going to mention the name of the carrier, but that was essentially shut down for some time due to the weakest link as a part of their infrastructure, as well as what we've seen with the Colonial Pipeline, for example, and that being shut down, and the massive amount of funding that it took in order to really get them back online. So, that all becomes a part of that rapid digitalization that we've seen, that underwriters not only have to, insurers not only have to onboard as they're enabling that digital infrastructure, but underwriters will have to understand as they're underwriting, the policyholders that they're looking to, provide services and provide coverage for. So that, essentially is, from my perspective, especially as we're thinking about proactive and reactive and sort of those trends and new risks that we've seen, that's essentially, some of the things that I've seen over the past 12 months.
Yeah, that's really valuable, Abel. And I mean, not just speaking to the cyber exposure, which has been front and center, and that has been a constant flow of front page news in a very crowded front page news kind of world already. But, you mentioned the Colonial Pipeline, JBS, which just had another attack last week. It's really nonstop at scale. Usually there'd be like one or two big ones a year. And then it's sort of like, the news fades, but it hasn't stopped. And I think you're absolutely right, calling out not just the tools changing, but what happens when the way the economy works changes. You create all these other exposures, and we have to be aware of that, certainly as underwriters. So absolutely, I'm sure that is something we will talk about more today. So thank you for teeing that up. Excellent comments. We already have questions coming in, which is great. And I've got some bubbling in my head that I want to dig into more. So Abel, thank you for seeding that already. Please, everyone watching, do throw your questions in the Q&A. Janet Moylan joins us as a Senior Vice President, North American Underwriting Operations from Allied World. I'd love to get your thoughts following up on what Abel shared and some of your thoughts from Allied World.
Excellent. Thank you, Brian, and thank you, Abel. And I would characterize what I'm going to share with you more of a case study of what Allied World experienced over the last couple of years and how we managed through it with technology as a piece of the solution. Our underwriting operations team is both the tactical processing team as well as the strategic team that changes our procedures, deploys new technology, and puts new products or geographies up for Allied World. So we both have the working and the strategic all blended into one team. So thank you for the opportunity. And what I'd like to start with is that in addition to the accelerated rate of change and the emergence of new underwriting risks, the new business submission volume is at unprecedented levels. As the starting point for an organization's premium growth and market expansion, developing tools that meet market expectations of speed and accuracy, coupled with a means to prioritize the inflow for our production underwriters, has been paramount at Allied World. Managing the increase in volume, which began well before the pandemic, we had to look across Allied World and devise a process that was as line of business agnostic as possible. With a solid understanding of current state, we worked with our chief underwriting officers to construct a set of rules that were standardized across our business units. Once we established the process, we were able to partner with a business processing firm and a technology firm to transform the new business clearance into an operating model based on quality and turnaround times. Both metrics deliver value to our external trading partners as well as to our internal underwriting teams. Clean and timely submission intake removes unnecessary friction and expedites our ability to consider quoting sooner. As part of this transformation, we deployed a workflow management system that will be continually enhanced with automation tools. Within our processes, there are opportunities to take advantage of both machine learning and robotic process automation that will further enhance accuracy and timeliness. An additional outcome of the workflow management system is an incredible amount of business intelligence that we never had access to before. Each submission is time-stamped, recorded, categorized, and tracked from entry to disposition. Moving forward, we are deploying this information in a way that makes the learnings actionable on a day-to-day basis for the processing team and provides triage opportunities for the production underwriters. As an example, we were aware that there were some lines of business that have a quote to submit ratio as low as 9%. What that means is we are unable to quote 91 of every 100 submissions received by the company. With this data in front of us, we turned our attention to developing tools that help the production underwriter manage their workflow, given the new reality of our submission volumes. We discovered a standard set of parameters that could be nuanced by line of business to indicate the most valuable submissions against the least valuable submissions. Our objective is to focus our underwriting teams on the most valuable opportunities for Allied World based on our underwriting appetite and our conversion rates. Interestingly, we found the behavior of how a submission is received by the company to be strongly indicative of our conversion success. The underwriting teams are now utilizing a submission dashboard and summary emails that consolidate and rank their new business opportunities, allowing them to prioritize their work effort with high attention to the most valuable submissions. Beyond submission prioritization, Allied World recently conducted a deep analysis of the number of administrative tasks on our production underwriters' desks that are required before an underwriter can start the true analysis or the underwriting of the risk. Our objective is to minimize and eventually eliminate all non-core tasks from the underwriter's desk. The non-core tasks reviewed include rekeying of data, cut and paste, search and rescue mission for third-party data sources, submission documents received in locked and inconsistent formats, varying synonymous terminology across all the received documents, submission materials for renewals, and a multitude of follow-ups for missing information. Consistent with our approach on new business clearance, we are documenting every step in our current state to ultimately move to a support structure that is both people and technology to deliver the underwriting file back to the underwriter at the point of analysis and review. So 2021 for Allied World is laser focused on the effective use of Allied World's production underwriters, both their time and their skill sets. None of this would be possible without a focus on empowering the Allied World operations team to think and work differently to support our underwriters. Likewise, underwriting and operations are a seamless partnership aligned in our priorities and goals. Our new steady state, like it or not, is change every day. To construct a team and a platform that is both sustainable and scalable for the growth of Allied World, we take advantage of Allied World's deep learning and development program for the careers and the professional development of our team at every level. We are focused on specific, measurable, achievable, realistic, and time-bound goals for each person. Allied World has a rich performance culture that requires collaboration and teamwork, and most importantly, purpose. As a company, we are focused on seeking and initiating change that drives our operational success in supporting our underwriters the most efficiently and effectively as possible. And so that's what we've been through at Allied World over the course of pre-pandemic and during pandemic.
No, that's really good to hear. And it's interesting when you're apart, you realize some of the data you don't have on the operations, because you could feel it on the floor before you, what the volume's like and where people are struggling, and you should still have the data, but it becomes even more apparent when people are suddenly dispersed, where you need more of those operating insights to figure out where do we need to hone our efforts and see what kind of changes we can make. So the 91% numbers is standing out as, yeah, how do you discover that if you don't have the data for it and you're no longer amongst each other to get the feel for, are you overwhelmed? Yeah, I can't even touch the stuff in my inbox.
Yes, all great points, in addition to taking a fully at the office staff and turning them for the first times in their careers to working from home. Yeah. Thank you very much for that, Janet. I want to turn now to Eugene Lee, who's the Senior Vice President and General Manager of the Insurance Suite at Guidewire. Eugene, you must have an interesting perspective looking across as many carriers as you do, as many functional areas as you do, not just underwriting, but seeing how it all comes together in the core. Love to hear your thoughts about, not just the change we've been through, but how we're sort of looking forward as an underwriting function, as an industry.
Yeah, great. Thanks for the question, Brian. And it's great to be on the panel. I feel a little bit out of place. Which one of these kids is not like the other, in the sense that I'm not an underwriter, I'm a technologist, but although I am a certified property casualty underwriter, I've never underwritten anything, but I hopefully can share some thoughts. I mean, I actually really like what Janet said earlier. It wasn't the first thing that came to mind when I was thinking about the webinar around moving from reactive to proactive, but one of the reasons why I think underwriting and almost all of our jobs become reactive is that the systems that they use, that we use, and even in my job or in your job, Brian, right, don't support the actual sort of workflow and daily tasks, and so we get bogged down in those things. It's hard. It's easy to forget that, like, sort of the basics and the underlying workflow and the sort of removing the paper is a critical sort of prerequisite to some of these more advanced things. And those advanced things, I think. Underwriting is by definition a proactive job, right? I mean, you're looking at a risk, you're trying to assess what's going to happen in the future. And, underwriters are at their best when they can they have a view, they have a narrative that they can build about a business, about a risk, that tells them something about what they think is going to happen down the road and why they should either underwrite or take on or not take on the risk. And I think that because of the changing nature of risk, and we talked about this before, but I like what Abel said earlier about the pandemic. I mean, I just remember thinking early on in the pandemic, it's like, welcome to 2025. I mean, that was just like, what you just got thrown right into sort of the future. And but with those risks with those changes accelerating, this sort of problem that's always existed in underwriting, which is getting underwriters data. Like how many if I think about the underwriters desks that I've seen, they've got Google Earth, they've got another search, they've got another thing they're searching for, they've got like all these windows trying to gather this information, and the deluge I think is worse, right? Because they're trying to like assemble a story, and the data they need is the volume and the variety, and the data they need is it's increasingly overwhelming because the nature of their risks is changing, right? So, getting raw data into underwriters' hands is probably not the challenge. I mean, I think underwriters are very creative. They're looking for new ways to assess risk. They're looking for non-traditional data sources. Our point of view, or my point of view, is that like that data has to be in the moment, in the flow of the systems they're using every day. And that's why I thought that Janet's view was really quite powerful. The other problem with being reactive versus proactive is this sort of this growing problem, and it sort of is becoming. I personally am becoming more aware of it post-pandemic. Is that like the nature of underwriting, the nature of pricing is that sort of what happened in the past is predictive of what will happen in the future, right? So like if you're in workers' comp, it's accidents rates. If you're in small business, you're looking at historical business interruption, liability claims, right, for certain class codes. And so like that's how we understand what we think is going to happen in the future. And if you think about all the stuff we talked about with cyber, there's like, you can't look at the past to predict the future. If you look at business interruption, the things that disrupted businesses and shut them down, we couldn't have imagined this, 5 years ago. And so these actuarial tables, these experience-based underwriting, they are still relevant, right? But they're part of a puzzle, right? And the puzzle includes sort of, there is an increasing need for like leveraging outside data, right? Like, something that is not so much like these losses or this frequency of loss is indicative of future frequency of loss, but these losses occurred because of something else that was predictive, and we can sort of some underlying other data, and we can use that underlying other data, right, about, dark web, penetration rates, pen tests, right, like sort of the things that we know about that we can use those predictive indicators to then see, like, what does that mean for future risk or future probability of cyber attack for a company down the road. The other hot topic I think is interesting is, and it's sort of been along the theme of proactive, is this sort of notion of continuous underwriting, right? Sort of like we should be looking at risks at all times. I think that when we look at both the sort of availability and frequency of data, the kind of new digital business models that Abel was talking about, there's this. I think what will happen, or what is happening, is sort of the broken assumption. The assumption is we're breaking the assumption of the annual insurance contract, right? Insurance is on demand, insurance is subscription based, and that means that risk has to be assessed all the time, right? And I think underwriters have always known this. That's why there are loss control teams. There are sort of, you have premium audit. You have all these sort of ways to assess a business, but those are largely sort of they're very manual tasks. So this frequency, underwriters are expected to know more. They're expected to know more frequently, right? And the risks themselves are changing, and that creates a sort of perfect storm, if you will, for underwriters. And so it's just sort of. I think that my personal view is just underwriting is really hard, and that increases sort of the expectations, or I've seen an increase in expectations of the technology provider, on the technology provider. So I think that, like, our point of view is there's sort of two parts to solving the problem. There's an evolutionary part. I think, some of what Janet was saying was just like this sort of the underlying systems, we put this in place, we sort of, the transformation is profound, but these are sort of automation and sort of digitization of paper-based processes. Those have to happen, and that is sort of, I think, relatively well understood in the market. And then the other is perhaps more revolutionary, right? Like I think, you know, Guidewire, for example, a couple of years ago acquired a company called Science. It was sort of underwriting in a completely different form, right? It wasn't a workflow-based underwriting. It was completely outside-in views on cyber, now small businesses, because small businesses are very dynamic industry. So businesses are created and destroyed in very rapid form. So it's hard to formulate sort of business-specific understanding of those risks, since they don't have a ton of history, and they may not have existed for a while. So
especially recently.
I mean, I think of
especially in the face of the economic
exactly.
tumult we saw now, or 2008 was another period where suddenly what people did and what business was shifted very dramatically, very rapidly.
Yes, that's right. So, I mean, so how do you get, if a business forms tomorrow, right? So we destroyed a bunch of businesses and new businesses took their place. That business is looking for, you know, a package policy, a BOP policy. How do you formulate a profile on that business, right? And so, like, that's an interesting problem that, at least in our world, we're trying to solve with outside data. Anyway, I think that reactive proactive is a continuous journey, right? I mean, I don't think that I think that it's, even for me personally, I'd much prefer to be proactive than reactive. I think we all would. I think it's just hard in the context of sort of these changes and these dynamics to keep up with that and to be proactive. And that just elevates the expectations on the technology that supports the underwriters.
Yeah, well, you said it really well. If you think about what underwriting is, it is a proactive job, because you're making forward-looking decisions to try to get ahead of, you know, what the rate should be, because of what the exposure will evolve into. When you said that, it was like, well, that puts it even more front and center, just how important it is for us to figure out how do we get more proactive in our ability to evaluate risk and get ahead of it, since that's sort of the core of what being an underwriter is. That was a great point. And if it makes you feel better, I was not an underwriter either. Worked around the space for years, but you're not the only one. So at least two of these things.
If underwriters were reactive, I think they would be claims.
Fair enough. I was a claims guy, so I'm leaving it there. Thank you very much, Eugene. Stephanie joins us. Stephanie Rushforth, SVP and Head of Underwriting Operations for Hiscox USA. Great to see you here, Stephanie. I'd love to get some perspective from you. And Hiscox, especially known for some of the small business focus, where data is becoming even more front and center. And there's a push from some of the startups to go zero question underwriting, or not really zero, but close to it. I'd love to hear some of your perspective about getting more proactive in our underwriting.
Thanks, Brian, and thank you, Eugene. I think it's really important to think about underwriting as a combination of both art and science. And I think just taking a step back as to where we are today is the question of the art and the science, are they mutually exclusive or are they interrelated? And then we have to say, why does it matter? What's the so what? And the reason why it matters is because what has gotten our industry to where it is today is not going to be what takes us forward. We need to evolve, and we need to make sure that we're a sustainable organization that continues to be relevant to our customers and provides return on investments for our shareholders. And many of my fellow panelists today, they've already spoken about the different opportunities that we have, whether it's integrating technology, leveraging data, building effective operation models to handle the volume, and how we become proactive versus reactive. But we still have to say to ourselves, how do we achieve that balance between art and science? And underwriting as a discipline has always positioned itself historically as more art, whether you're writing a large national account with a bespoke policy form and individual risk rating versus a nano small business company with an off-the-shelf product or standard pricing. but the process steps an underwriter takes to complete their analysis and what information is used in that assessment is specifically what needs to evolve. So coming back to my first question is insurance and underwriting art or science? How do we combine it? So we have repeatable transactions incorporating those predictive analytics to assess whether each risk is aligned with a carrier's appetite. So carriers need to challenge themselves to look at their own operational models and make a risk-based decision. And in insurance, we love making risk-based decisions as to their tolerance to rely upon a combination of technology, AI analytics, and external data to make that underwriting decision. And that threshold is going to differ for each carrier. And that's okay, because that goes back to the individual appetite of the carrier. So where we're going with all of this is by being able to make that decision as to, is it going to be 100% science? Or is it going to be that we're going to allow some art to remain, but we're going to augment that art with science? And then once you have that decision, then it will inform you as to where the underwriting processing model needs to be and the degree by which the technology, the automation, the data will drive the solutions for the volume and the need to be proactive. So it's taking a step back, because we all know that the digitization of insurance has to take place. And there's a lot of external data out there that we can better leverage. But the question is, to what degree do we want to utilize that? And then once you make that decision, then you know which avenue you want to go down. And the solution for each carrier is probably going to be a combination. And not to sound cheesy, but I think insurance is at a really pivotal moment. And it's a really exciting time to be in insurance, because the legacy of what our predecessors have built is a really good building block for us to go forward. And we are the caretakers to be able to make those informed risk-based decisions to decide what we're going to look like. And if we're going to be 100% automated, are we going to be 100% art, or is the answer somewhere in between? So hopefully this wraps everything up by incorporating everything that my other panelists talked about. So thank you again for having me on.
Thank you very much, Stephanie. And I'd love to invite everybody back on camera so we can all join in the fun of the Q&A. We've had a number of questions coming in throughout, which is fantastic. Now the hard part is picking out which ones to dig into. One of the questions was, will this be recorded and will the recording be shared? That's an easy one to handle. Yes and yes. For everyone who registered, you will get a link to the recording. And of course, if there was something pivotal that one of your peers could benefit from, feel free to share that with them, but that will go out through email to everyone who registered. So with that, thank you again to the panel. Fantastic conversation. To the attendees, you can keep asking questions. You don't have to stop. This conversation is likely to spark more, so by all means, but we do have a lot already. I'm going to start with one. This touches on something from a few of you. I think particularly Janet, it might have been sparked by your comments about the non-value added time or the repetitive time that underwriters are spending on dealing with the process pieces of it, rekeying, going through the submission documents. So I'll start with this one, and Janet, I'm going to throw it to you to begin with, but we will go around. The question is, one of the biggest challenges of commercial underwriting is the unstructured data. And I think this varies on different lines of business, more so in specialty lines, less so maybe in some of the Main Street kind of BOP and GL and more, auto lines where it's more factual data that it just sort of is what it is. But you've got submission emails with accord forms or not. You've got different kinds of schedules. Maybe it's a competitor's app or a competitor's schedule that you have to make sense of. Loss run attachments, of course, they all look different, and they're often PDFs and not necessarily data PDFs. They might be images, so you can't copy and paste out of them. It's hard for bots to make sense of them. So we've got a lot of different data that isn't easily ingested all the time. and underwriters or underwriting support staff spend a significant amount of effort analyzing and manually entering that data into rating systems, or worse yet, it doesn't get in there, or it's just uploaded as an attachment and the data never gets sort of made into useful data. So a person would love to hear your expert opinions on that challenge of unstructured data. And is that something that you've been addressing in the past year? Is that something that maybe moving to more third-party data and other kinds of ways of making these sort of, underwriting decisions? Eugene, you had said it's like the revolutionary change. What if we did underwriting in a wholly new way off of different data? Does that solve for it? But this is a meaty problem. I'd love to just hear some thoughts about how we deal with the world of unstructured data in underwriting. So Janet, start with you, since I think it was sparked by your comments.
So it's absolutely everything that you said and more, and it's ugly. And Allied World has a wide range of businesses, from the largest insureds to our smallest insureds. So in terms of where we started on due diligence, I was focused on the most complex. I was focused on all the unstructured loss runs, focused on underwriters who have to summarize 5 to 10 years of loss history, and it all comes in from different carriers and different formats with different terminology, although the terminology ultimately maps to one thing or one insurance term. I was also focused on large schedules, whether it was commercial autos, trucks, property schedules, CAT modeling. But in the 5 weeks of our due diligence, we find all of that terrible unstructured accord. Every variety of any type of information can be received by our underwriting team. But we also found quicker and sooner opportunities for just rekeying data. And we took what they're ingesting into their rating tools, and we identified the quick wins versus a more long-term solution. And so the language in the vendors that we've partnered with is lift and shift. And I would say to all of you, you cannot pick your future state until you intimately understand every keystroke on that underwriter's desk. And really the challenge to make this successful is to see what's common across the different rating mechanisms, because the rating mechanism for each underwriting team is different. So what kernels could we draw from to, again, get at what we're focused on, which is some level of corporate standardization? Not everything can be, but where can we take advantage of the items that are common to then solve those as low-lying opportunities for change? Because you have to take change one step at a time without disrupting the incredible market that we're in today, where our underwriters are able to grow our company the way it's being grown today. So I hope that helps, but it's a lot.
I just piggyback on what Jen said. I mean, I think that as obviously an underlying workflow system provider, the unstructured data is a real pain, right? Because, the rules, the best practices, any sort of automation is completely useless, other than pushing documents around, if we rely on the contents of those documents. So that's where we see things. I mean, we're investing. There are a lot of tools that are invested, a lot of people and tools available around what's called robotic process automation. It's a fancy word for scraping stuff and sticking it in the field. And the good thing about insurance is that, so you can talk about unstructured data, but I think you could break it down. I mean, there's certain things that live in forms, and they live in forms in relatively the same way, right? And so it just, so we've been investing in basically form ingestion. It's remarkable to me how many forms there are. So it's a sort of a never-ending, it's a long march. Loss run formats. I mean, we've actually sort of mapped the most common loss run formats. We've ingested those, put them in. I think large schedules are more complicated, but large schedules is next on our list. I mean, I think that's certainly one category. I think then there are other categories of unstructured data that are not standardized, and those become much harder, right? Those just I think that it would be great to see a world where where those forms would be 100% ingested, stuck into fields, those loss runs, those schedules. I think that would improve the current situation immensely.
I wanted to talk about this because that is absolutely something that we've been targeting over the past few years, and essentially, I think every so often we can talk about it in the context of text data, but we have to remember that unstructured data is not only just the text, right? It's the video, it's the photos, it's the text that we're getting on the underwriting applications and so on and so forth. As we're looking at the capabilities, for us, what we've done was a handful of things. First and foremost, especially for the text, we've deployed some capabilities around RPA, robotic process automation, in order to lift and load some of that information, especially as you're looking at, hundreds of lines of losses on loss runs, or information that may wind up coming in, from some of our agents as they're hoping for us to potentially underwrite these policies that are coming in. I think the other thing, though, that's extremely important is not just lifting and loading that text, but really having the ability to understand what that unstructured data is telling you, right? So, creating and building and leveraging artificial intelligence and machine learning with more cognitive type capabilities that will then help you to, pick up, lift and load and structure the data in a way that's consumable by our underwriters. The example that we've actually done that with photos, videos, and text is actually in the claims world. So in workers' compensation, I mean, you could imagine, right? If you're if there's a worker that's getting injured, for example, there might be the need for that individual to go to a doctor and that doctor to write a prescription. Well, that prescription could then drive another issue with that worker, especially if it's related to opioids, and it could potentially have some other issues if as they work together, right? So, when you look at the massive amounts of data that's in the system, it has to be able to discern not only the fact that there's been a claim, for example, and what the claims adjuster has put in that box for unstructured text, but also where there might have been a prescription that was put in place, and then take that and start a trend and try to figure out if there may be multiple comorbidities that's driving a worse loss outcome. So there's a lot of ways in which we've been looking at really leveraging partnerships with insurtechs, as well as development of our own models and algorithms in order to be able to understand what that data is telling us, and then apply it to the underwriting process for both underwriting as well as claims.
Ryan,
go ahead, Stephanie. Yeah.
Oh, if I may, I think it's also a question of whether or not, does the unstructured data matter? Just because we've always asked for that information, it doesn't mean that we need it going forward. So I think we have to take a step back and really challenge our product experts and whatnot to ask the question, is it a nice to have, or do we really need it to make an informed underwriting decision? Or can we supplement it with external data that's as good enough? And also, going back to my earlier point, I think you also have to look at the unstructured data from a segmentation. Is maybe our threshold to be able to try to solve the unstructured data means more on the larger accounts. Maybe you don't have the appetite to do something on the larger accounts, and you have to get to the root cause of, we have hundreds of different applications in the industry that are coming in. So can we potentially bypass that and have information come in through our own funnel? I think those are the types of questions that we should also be asking, and not just trying to solve the unstructured data.
Yeah, it's hard when we start from a place of, well, these are the questions we've been asking, so which ones can we get rid of? That's a different exercise than what do we actually need to know? Because you get into a lot of, well, we've always, and that's not an underwriting rule. We've always, there needs to be some sense of what the exposure is from the information you're getting. And if it's not serving that, then maybe, you need to ask something else or nothing at all. But it's hard to do when you're starting from that list of 119 or whatever questions and you're trying to pare it back. It's not the same exercise. We have a question about compliance, which is always an exciting topic, but I think it matters. when we start thinking about new sources of data, other ways of looking at data, processing it, invariably, the question of, is that redlining? Is there bias in it? That's gonna come up. In commercial lines in particular, how have you seen the compliance question come about? How are you navigating that, especially in a time where suddenly you had to be much more likely to turn to third-party data and digitization of how you're taking data in, and how are regulators going to look at that? So if we can touch on the compliance question, I think that's a great one. Someone want to jump in on compliance?
I'll start, because that's the other side of my role, in addition to underwriting operations, responsible for the controls and standards in the US for Hiscox. So I think the question with regards to compliance, it's always very important. Insurance is regulated at the state level, and if you're a Lloyd's syndicate, you also have London at play. So you always need to strive to make sure that you're not being discriminatory. So, and going back, it's a threshold question. Like, different carriers may have a different tolerance level for taking on risk. But with regards to outside data, as long as you use it consistently and uniformly, where in good faith you can say, I have 2 plumbing companies in their identical risk, and if they go through the funnel and have the application of the external data applied, they'll come out with the same terms and conditions and pricing. And to be able to say that we're being consistent and not negatively impacting the consumers, because the states care about the consumers in addition to our premium tax we pay them, but they want to make sure that their constituents are protected.
Sure. Anyone else have a view on this? Eugene, yeah, you just came off.
Yeah, I was just going to say that it's pretty quick. I mean, I think that, like, in analytics, right, we're vendors, including us, we're generating risk scores, right? And like a credit score is a kind of risk score, and that's inherently has sort of some, has some controversy around it. I think that we get asked, and I think any insurer should ask their vendor, right? Like, obviously you want to know, like, is this risk score predictive? How do you generate the model? Tell me more about why it's the best available option for me. But also you have to ask sort of what goes into it, right? Because if the data sources that go into it have sort of bias in them, have discriminatory aspects, you can pretty much guarantee that the outcome, even if because the models are not easily understood, like we can't like decompose them, but you have to be careful about what goes into them, right? So we have to expose to our customers, meaning as a vendor to insurers, both sort of why the model is great and show them the lift and blah, 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 but also at the same time, sort of here's what goes into it, so that you can feel comfortable that sort of that you can explain this as non-discriminatory to the regulators.
And I'll jump in, because I think there's multiple components that's associated with this, right? One, of course, is what the regulators are going to require, as that data is being applied, because of course the regulators are going to want to make sure that we're protecting the policyholder in all of this, right? So there has to be an element of consistency in how that data is being leveraged, but also how the model is being applied as well, and consistency in how it's feeding in the model, in order to make sure that you're not getting that bias or discriminatory nature of how you're using that information. Now, with that said, I think there's another component that creates more of a human component to this, right? Because remember, there are humans that are building the predictive models and how the models are leveraging that data and that information. Meaning that when you're building a model, your bias may wind up being reflected in the model that you're building, right? So I think that is the other element that we have to be extremely cognizant of. We've seen that in auto insurance, for example, with the use of credit scores and the outsized impacts of credit scores for communities of color, for example, right? And that's one example where while I think credit scores may be very specific, when you start to circle that around a certain community, a certain geography, or so on, that's where the bias of whoever has potentially defined that model may wind up playing into the development of how that was pieced together. So, you know, in my mind, you know, I absolutely, you know, think through around like the consistency and the accountability, you know, in order to make sure that it's non-biased. But I also like to remind folks, hey, we have to think about who's defining this to make sure that as it's being built, that there's multiple perspectives that's, you know, that's creating that in order to try to drive out some of the bias and discrimination that can be put in place in the event that that data is being used in that way.
Yeah. Yeah. And who's training that AI and who's validating the results and saying, oh, we didn't accept these results. We need to change the model. Everyone has biases regardless of what they are, conscious or otherwise. So it's invariably in there. Yeah, there's people building it. So we do need that more front and center. Janet, before we move on to the next question, is there anything that you wanted to add to this? Or you?
Just to concur with everyone, and the behavior has to be non-discriminatory, and that's the baseline.
Yeah, yeah. No, it's a key point. I saw a few questions on this, and based on the time and the scale of question, I have a feeling this may be the last one we get to. Hard to believe we're almost coming up on the hour. But this is around the question, Stephanie, I think you sort of were hinting at this a bit in the question of like, are we, you know, if we've been asking something, is that really the litmus test for whether we need data for it or not? The question is this balance between getting the outside data and trying to pre-fill things or not have to go through the manual exercise versus at some point, you know, you take in that data, you do the underwriting, is the product fit anymore? So is the product actually fit for the market? And, you know, Abel, to your opening comment about the nature of risk changing and the exposures changing, if our products were developed even 5 years ago, but let's be realistic, probably the core of the products that most of us are working with are 50 or more years old. The concept behind them certainly is even older than that. Is that product still fit for purpose, regardless of what data we can pull into the underwriting or not? And maybe some of this third-party data and the newer models are going to bring that to a head, where we realize our sense of the risk no longer can fit into this rating model anymore. I'd love to just hear some thoughts about that. Are we going to bump up against the limits of the product suite that we have, and do we need to reconceive what we're underwriting with in the first place?
So I'll kick us off on that topic. I think the answer is yes. A lot of these products, the concepts were developed some decades ago, and what might be fit for purpose and the risk at that time, it's very, I mean, you could take a very basic approach of saying like, oh, like with D&O insurance, originally it was just for the individual Ds and Os, and now you introduced in the entity coverage, and now you have the non-indemnifiable side of the house. So it's evolved. And I think that's the point, is it's not just the product that has to evolve, it's the data that has to evolve. It's the question set. It's the underwriting analysis that has to evolve, because, for example, looking at an employee handbook for EPLI insurance, like, that's great. That's going to tell you whether or not they have a handbook, but it's not going to tell you whether or not they execute it and they comply with it. And so we don't necessarily pay our underwriters to read 100-page employee handbooks. But the point of the matter is, when EPLI was first started, that was a fundamental question, but it's evolved. And I think we constantly need to challenge ourselves to say, what's the so what here? Why does it matter? What is it going to get me? And need to focus on the 80% versus the 20%, because underwriters are inherently trained to focus on the outliers, but that's not cost effective for us. So we need to help steer them and guide them into focusing on the 80%.
Yeah, you know, Stephanie, I think that's a really great point, you know, and even as I think about, hey, we'll have, is the product fit, you know, for what we're seeing today, and, you know, with all of the capabilities and the technology that's around us, I just say, let's point back to something I mentioned a little bit earlier, you know, the fourth quarter of last year, you know, all the way through this year, and the cyber risk that we've been seeing, and that significant, you know, issues with all of the bad actors that's been driving ransomware across all industries that we've been serving, to the point where, you know, this year, they're getting 80% plus rate on cyber policies, right? So essentially, the industry has been looking at pricing as a way to solve that, whereby pricing necessarily isn't the only way to do so. You have to go back not only to your core product, but the capabilities that you're putting around the product in order to support that. You know, so for example, why not partner with an organization like you know, Guidewire, and I know you guys have acquired Science a few years ago, and you know, leverage the ability for Science to go out into the ethosphere, understand you know, the third-party gaps or the gaps that could be surrounding the policyholder, you know, score them, and then pair that with the cyber policy, but continue to take that and move it forward, right? So in essence, it's not only the base insurance product, but you're leveraging other products and capabilities in order to support that rapidly transforming risk that we've seen, especially with something that's been evolving so rapidly like cyber.
Yeah.
I'll buy you lunch later, Abel, for plugging me.
It's not as
So I
simple
would-
as just charging
go ahead.
more.
Go ahead.
The fundamentals are changing. Yeah.
Exactly.
I would
Janet,
just
I cut you
briefly
off,
add
yeah.
that the natural outcome of the exercise that we have partnered with our underwriting teams to do the due diligence review is for the underwriters, now that they're displaying every keystroke to us and our partners, then they question why. And that's a healthy question. And then we bring it back around to the business leads and the chief underwriting officers and the actuaries, and we can now have those discussions. But based on the volumes of submissions, if we weren't stepping back to say, what is on your desk and what do you do each and every time you have a new business submission and you have a renewal, and seeing that is giving us the opportunity to take it to the next level, which is, should we still be doing it that way, or can we move on to additional alternatives for the team?
Yeah.
And I was just going to say, oh, go ahead. Right.
No, Eugene, all you. Yeah.
Okay, no, I was just going to, it's more agreement and piling on, but I think there are layers, right? I think the notion, like this notion of prefill, which I was like, what's prefill? Just the sense that we could automate things that people, meaning consumers, brokers, or underwriters wouldn't have to rekey, right? But you still have in a prefill, like the concept, the definition, you still have the form, the application form itself, right? The application form itself assumes that the applicant actually can answer the questions, that they understand the questions and can answer things that would help you inform how you would sort of underwrite their risk or price their risk, right? But in the case of like cyber, they don't actually know. That's the problem, right? It's not that there's like 1,000 questions you want to ask. They don't know. The person who's filling out the form may or may not know a key element that would impact how risk, like whether they would be sort of a victim or a high frequency victim of ransomware, because it would be how attractive is the target, how up to date their technology is, sort of compliance with whether they have the right kinds of like security roles filled, whether they have, so and I think that cyber is the easiest to sort of wrap your head around in terms of how complex this problem can be. But I think we've talked about it internally around even what Stephanie's talking about earlier, EPLI, right? How can you assess a company's compliance with their own procedures without sort of like, because if you ask it in an application, I can as a technology provider, I can automate that for you. The answer is yes, right? Do you comply with your 100-page like manual? Yes, click yes, right? That's prefill, right? But the actual compliance level with that and sort of the sort of posture of the company may require a little bit more digging, and that's not a form or a prefill.
Yeah. Well, I think there's no time left, but there is maybe a parting idea from all this, is this notion of challenging what we've been doing and why we've been doing it, whether it's our operations. Janet had some great examples of the work that Allied World and that a lot of us have been doing in that front. The questions we're asking, why we're asking them, Stephanie, to your point, to the point Eugene was just making, Abel, your whole point on the exposure. And it's not about, well, how much wiggle room do we have in our rating plan? Can we just charge them more for it because now they're doing more online? Well, they also kind of sleptwalked into that, or they were being reactive in it, which feels like you're going to be far more at risk from a cyber standpoint than if this was a concerted, like we're pushing online and we're doing it this way. And because they were as reactive as we've all had to be. So the nature of exposures changed. Is the product even fit for purpose? Are we thinking about it the right way? And why ask some of these questions when the answer is, of course, they're complying. What else are they going to say, right? And every professional liability app that asks, do you use contracts? What's the answer going to be? And do you abide by your contracts? Of course I do, until that lawsuit comes in. And then you realize, well, yeah, maybe not exactly. We need to rethink what we've been doing. And if nothing else, this is a time where I think that question has been brought front and center. Fantastic conversation. We got through literally half of the questions that people asked, and that's only because I was doubling up saying, well, we kind of answered both of these. So it's being generous. Fantastic engagement from the attendees. So thank you for that. And to our panel, great conversation. Stephanie, Eugene, Janet, Abel, thank you all so much for today.
Thank you for having us.
Thank you.